Profitable. That's the word every investor loves to hear before an IPO. But what if that profit isn't quite what it seems? More and more new age Indian startups are suddenly turning profitable just before their IPO filings. And experts say that's not always a good sign. Let's start with Lenskart. In FY25, the company reported a net profit of 297 crore rupees on revenue of 6,652 crore rupees. Impressive. Until you notice that 167 crore rupees of that came from a one-time gain linked to its own day's acquisition in Singapore. Take that one out and the actual profit drops to around 130 crore rupees, a net margin of just 1.9% compared to the reported 4.2%. Even in the next quarter, Q1 FY26, the margin was only 2.8%. So yes, it's profit but thin profit for a company valued in tens of thousands of crores. And it's not just Lenskart. Urban Company posted a 7 crore profit right before its IPO filing and then went back to a 59 crore loss soon after listing. Pine Labs too. Losses narrowed from over 340 crore rupees to 145 crore rupees and then suddenly a small profit in Q1 FY26. But analysts say the trend looks more like volatility than stability. So what's really going on? Analysts call it the pre-IPO profit push. It's when companies make accounting adjustments or time their expenses to show profits in the short term just before listing. Nitin Jain from Bonanza Research says headline profits are often boosted by one-offs like reversal of incentives or deferred costs. And once you remove those, underlying profit actually declines. Now, this isn't illegal. Shruti Jain from Arihant Capital says, if it's disclosed properly, audited and follows accounting standards, SEBI cannot really step in. So the problem isn't legality, it's sustainability. Because most retail investors do not read the details. They chase the grey market premium or the market buzz without checking what's driving the sudden turnaround. Vineet Bolinchkar from Ventura Securities calls it worrying. He says, these accounting-driven profits can mislead investors, creating overconfidence in companies that still don't have steady earnings. His advice? Well, focus on cash flows and core operations, not just the profit number. Veteran investor Sandeep Sabharwal calls it out bluntly. Profits right before IPOs after years of losses, it's a pattern, he says. And then the IPOs are priced high and still get subscribed. So what should investors do? Look deeper. If profits come from asset sales or accounting gains, that's a red flag. If they come from steady operations and growing margins, that's real strength. Analyst Khushi Mistry says investors must move beyond the headlines and focus on long-term performance, not on short-term hype. At the end of the day, a profit before an IPO doesn't make a company investment worthy. What matters is whether it can sustain those profits or not through consistent cash generation, improving margins, and transparent governance. Because in the stock market, short-term profits may sell the story, but what matters more is sustainable earnings and trust. That is all for today. Keep watching ET for more.